Okay, this is Business 342, Workbook Lecture, page 85. Suppose we have a bond issue currently outstanding that has 25 years left to maturity. The coupon rate is 9% and the coupons are paid semi-annually. The bond is currently selling for $908.72 per $1,000 bond. What is the cost of debt? Okay, so the way you go about this is semi-annual. So the N, you got 25 years left. So 25 times 2 is 50. The present value is 908.72. You make that a negative number so you don't get error 5. The payments, it's a 9% coupon. 9% of $1,000 is $90 a year, but since this is semi-annual payments, you divide 90 by 2, you get 45. Future value is 1,000. Compute the IY. So the cost of debt, the IY, or you can say the RD, either way, is 5%. But since we're figuring semi-annual periods right here, you have to multiply this times 2 to get the annual percent, and that's 10%. Okay, it says note, we're concerned about the after-tax cash flow, so we need to consider the effect of taxes on the various costs of capital. Okay, interest expenses reduce our tax liability because it's an expense and it lowers your profit, so you pay taxes on your profit. So you can write off interest expense. This reduction in taxes reduces our cost of debt. Therefore, after-tax cost of debt, which is RD times 1 minus the tax rate, where T is the firm's marginal tax rate. Dividends are, so that's how you figure out the after-tax cost of debt, RD times 1 minus T, which is the tax rate. Dividends are not tax deductible, so there is no tax impact. That's dividends on common stock, that's dividends on preferred stock. They are not tax deductible. So if they say something about figuring out the after-tax cost of dividends are preferred or common, there is no after-tax. It's all the same. There's no tax deductibility to dividends because they're considered a return of capital to the owner. Okay, compute the cost of debt in the above example if the firm's marginal tax rate is 40%. So the after-tax cost of RD, which was 10%, times 1 minus the tax rate, so 10 times 1 minus 0.4 is 10 times 0.6, which is 6%. The cost for preferred stocks. Preferred stocks generally pays a constant dividend every period, so there's no growth rate to consider. Dividends are expected to be paid every period forever. Preferred stock is a perpetuity. So we take the formula, rearrange it. Remember, basically, it's almost the same. For perpetuity, it's P0 equals D, because there is no D0, D1, they're all the same, over RP. Okay, this is the return. It could be RP minus G. It could be just like the other formula, but G is 0 in this case anyway, because there's no growth. So it's just P0 equals D over RP. Therefore, RP equals D over P0. Again, you could put plus the growth rate, but since it's a constant payment, there is no growth rate, so it would be plus 0 anyway. So it's the same formula, it's just there's no growth, so you just take out the G part of the equation. Okay, the company has preferred stock that has an annual dividend of $3. That doesn't change, right? If the current price is $25, what is the cost of preferred stock? For perpetuity, it's just the dividend over the current price of the preferred, which is 25, equals 12%. So RP, the cost of the preferred stock, is 12%. Now it just depends on whose standpoint you're looking at. From the company's standpoint, it's the cost of preferred stock. From the people that have the preferred stock, the equity holders, it's return on preferred. Either way, it's the same thing. It just depends on whose vantage point you're looking at. Then there's the weighted average cost of capital. And basically, you're just taking the debt and the equity, whatever weight that has, how much debt there is, how much equity there is. the total value is adding those two together. You just figure out what the weight is and multiply it times the return for preferred or the return for equity or the RD, the RE, or the RP. Okay, so we can use the individual costs of capital that have been computed to get our average cost of capital for the firm. It's just a weighted average. The average is the required return on our assets based on the market's perception of the risk. The weights are determined by how much of each type of financing that we use. Okay, so that is page 85, business 342, workbook lecture, or lecture workbook, lecture pages in the workbook.